We're going to be looking at core retail sales number, retail sales, unemployment claims, and the medium impact Philly Fed manufacturing index. That's all going to be released this morning at 8:30. We are looking at the NASDAQ, and let's start with the daily chart. We do have a really nice sell side still building underneath that. Buy side is here. We have Tuesday's October 15th daily high, the 60-minute chart. And right away, you should see this is just begging for it. So in my mind, it's a little too clean. I like the idea of a potential run up into that. It doesn't need to do it today. It may need to do it overnight tonight. It may need to do it tomorrow. It's reasonable to anticipate them taking it up there to those 640s at the minimum. And then Tuesday's high, 659 and a quarter, 680 respectively, which would be this high there. So I'm looking at how we made this area down here, which was below these relative equal lows. They made that jagged. We're trading up into the SIBI here. And to me, being in an election year, it's very difficult to try to short this market and hold for a long time because they keep sending it higher. And it's all artificial. Focusing on the buy side is always going to be my first go-to. So I'm going to be looking for things to justify something that would lend well to a draw up into these two respective highs. That's where my initial interest is. When these news events come out, they're used as a smokescreen, and sometimes they can aid a run into a layer of liquidity, and then other times it'll be used to drop it down and get everyone thinking that the sentiment is bearish, and then at the opening bell later at 9:30, then they make a run for it to get up here. Either scenario, I'm just interested in what they're doing at 8:30. We'll drop down to a 15-minute time frame. I still like the idea of it wanting to get up here because it's two reference points here. We have this high to that high, this high being lower than that one, and then this high and that high being lower than that one. So we have two nested relative equal highs. It's just real obvious. And whenever it's like that, it's easy to decide with that as the initial draw until price proves it's not interested in that. And you would know that obviously by what we see at 8:30. Trying to figure out what that fundamentally means, it's useless. It's better just to anticipate the fact that we have a high impact and medium impact news events. We are never interested in what the data is suggesting. All right, so we have the market break above the short-term high here after having a run on liquidity below this low in here, trading back down once more into a delivery to this volume imbalance. Rallies up. That means the breakout arcs are going to be long above this high. I love seeing false breaks where a breakout trader would get in long or short because the market's predisposed to go higher because it's an election year. This high, they would have went long. They ran down, stopped them out. That's a beautiful setup because now what did they do? They took the market higher, putting traders in long, ripping their guts out. And then what I'm going to wait for is I want to see, does the market give me an opportunity to get in when the price is dropping and it's going into an obvious discount array. We have this imbalance here after clearing this high, all of this consolidation here. This is resembling much like a first stage accumulation. Looking at it like that, we trade down into the fair value gap, always including the volume imbalance. So anyway, the market drops down into the fair value gap here, which is a buy side imbalance, sell side inefficiency, when the market's likely to go higher. We're approaching the 450 to 510 macro, and I'm accumulating an early position, anticipating that this volume imbalance into this area, anywhere in that price range between this volume imbalance, right there is my fill. It went down, and then once it went back into the volume imbalance, you can see my fill was right there. And then we have a breakaway gap. That's why I shaded it yellow, because I wanted to see it stay open. Any other time you would see a green or blue, that's bullish. And then I entered here on a retracement back down into this order block. That means this is a propulsion block. And then right again, it trades back into the propulsion block. If you look at the month 4 content, 2016, I teach you the propulsion block. Propulsion blocks can be traded to again, as it does here. I'm entering it as it's trying to go down into it. I'm hitting it there, and then exiting out right up there. Ultimately, it rolls back down and comes back for my initial entry. How did I get this exit? Where did that come from? Well, if you take the fib, place it on this price run here, negative 1.25, that's what I'm aiming for. The quarters is when there's going to be another retracement back. There's sell side here. We've already disturbed this. We have a little bit of a ways before we get up to those levels up there, but we could certainly make some ground. I'd like to see them first take this sell side out here, mess this up a little bit. Holding a bias to the bullish side, but loosely because I'm more inclined to anticipate what it's going to do going into the opening bell at 9:30. And because there's multiple reports coming out, there's always like this staggered initial rally or decline, and it feels like it's done. It's not. You got to give it a couple seconds, and it'll be like another impulse. When it's one report, like medium impact or high impact news driver at 8:30, usually it's the first run that is your Judas swing. But because we have multiple reports at 8:30, give it a chance to take both sides of the marketplace, annotating where short-term buy side is. If it goes below here, notice this low here as well. And below these lows, we have this imbalance here, and we have all of these candles here that are indecisive. So whenever it's like this, we have a fair value gap, and then we have two indecisive candles. Notice that? So you would think that this would be how you would frame that imbalance. So if we go below the lows here, where could it trade to? The way you would do that is your lowest open and close, which is the same on this candlestick. It's also the low of the volume imbalance here. You got to cover over top of this and this entirely and take it all the way down here like that. That would be your inefficiency. So if it goes below here, that's how I would use it. And then you can use consequent encroachment of that. And the reason why I told you that is because if there's any inefficiencies like volume imbalances or indecisive candles where the bodies are just the open and close the same price, you got to use the lowest one. It's better for you to do that because there's so many reasons for it to drop down into these volume imbalances, and it would just overshoot the typical standard fair value gap. I like how he left that here too. See that? Let's play devil's advocate. Let's assume for a moment that between now and 9 o'clock, we don't make a significant higher high here. Now, it can come up and just poke that and come back down into the range, chop around a little bit, and then drop down here. And then if it does that, then I would expect 9:30 to 10 o'clock to give some kind of movement higher, displace higher, and then start looking for discount arrays like bullish order blocks, fair value gaps to support price, but not trade completely closing the low of it. Look for short-term lows to be swept and then rally higher. That would be what I would expect if it does that very thing, trading down here. If we keep this high and we just bang around in here and don't do this drop down here yet, I would look for the Judas swing at 9:30 into 9:45-ish, something like that. Drop down into that and then send price higher, taking out this high and then accelerating and working towards objective up there. So 20,659, Tuesday's high. And it keeps me specifically from trying to pick the tops in the market, which is really important. Do all your work about trying to avoid the biggest mistakes, and it's always going to be by trying to pick tops and bottoms. It's easy to pick the lows or the bottoms in bull markets, but it's really difficult to try to pick tops in a bull market. And when you're in a market that's like we have, where it's an election year, there's a whole lot of manipulation as a result of the election year. I'm watching this volume imbalance in here. If you didn't have this big run here, what would you see? Relative equal highs, right? So this first pass up here, I would completely ignore that. Even though that's where near-term buy side is resting, I'm watching these two relative equal highs. I'm ignoring this. Obviously, if it goes above there, it could revisit this high. I'm just saying that my eye is jumping to the fact that these two highs are basically identical. So what could happen is, say they're going to hold the market and keep it from going higher until we get into the opening range or later in the morning session, or maybe even in the afternoon. If it goes above these relative equal highs, it can go up to about halfway there and leave that high intact, and then roll down, take out these relative equal lows, take out these relative equal lows, trade into the inefficiency, and then how it would trade down into that would be indicative of what I would expect to see happening in the 9 o'clock opening bell, assuming that it doesn't break lower. These high impact news drivers didn't do very much. And you can see the market hasn't had a lot of range delivered. Nothing in here that I would want to be buying. So if it does take off, it left without me. It's fine. Just like you saw yesterday with the first presented fair value gap, it didn't give us an entry to get short, even though that would have been the play. Sell side was the objective because it didn't offer an entry. We're just going to use it as a target later on. So normally I would like to have something in a position ahead of the 9:30 opening bell on a high impact or medium impact news driver day, but I have nothing in here that I would have entered on, so it's kind of like to sit and be still. That's the consequent encroachment level I was telling you, between the relative equal highs to that high. I'm watching that. You can already see they're working that level. I would like for it to stay below this high, and I'd like to see it come back down and disrupt this or disrupt that and make an attempt to get in here. That would be ideal because that would set the stage for me to really be bullish this morning, but I wouldn't be interested in chasing it in here. I was hoping to do a little bit more get up and go this morning at the 8:30 bell, but that's good. I mean, we should have a reasonable morning session. It should deliver nice. Because of how price is being delivered, see how spotty it is? We got a lot of wicks in here. We have volume imbalances. It's not making a higher high. It hasn't made a lower low. It's just maintaining the initial range that was created at 8:30. This low didn't get taken. This high hasn't been broken since it's been posted. So we're held in a holding pattern, which means the hands in there. The algorithm's not doing anything here. And whenever you notice those types of things, sit still. Don't do anything, because you're competing against an individual that literally has the control to take both sides of the marketplace and still go nowhere. But it'll look like you're in there taking a very valid long or a very valid short, and then it just evaporates. And when it's like this right now, there is manual intervention. There's no cleanness to the marketplace. It's being held in a range, and because of that, you sit still. tape read it. You're in here studying what you're feeling, how you are perceiving price action. And then you're looking for signatures to support or negate the idea that the algorithm is running on script, or is it being screwed up by manual intervention? That means the actual market maker is in there doing it manually, sending it to different price levels, but they're still going to follow an MO. Perfect example. I mean, you probably were looking at that wick when I was telling you disregard it, even though we have to define that for near term minor buy side, because that's the high at 830. I took your eyes to that high and said, ignore this for a moment. These are your relative equal highs. So I would like to see it trade up above that and use consequent encroachment of the portion between these relative equal highs to that high. Look what it did. You can see the bodies. Are they respecting that level? The wicks are being tossed above it. So are they trading to that consequent encroachment of the relative equal highs to here? The wicks are, but the candlestick bodies are stopping. So we have this volume imbalance too. I want to see it dig down into that, just like that. Now it should accelerate and run below these lows. If it does, if it accelerates below these lows, it'd be reasonable for it to try to make an attempt to clean up all this area here and then maybe deliver to this inefficiency I have shaded in blue. I would not be interested in being long yet. It's still working out the interventionist. So on your charts, what you want to do is you want to annotate the volume imbalances inside that range, which is the 830 delivery. All the volume imbalances, you want to extend them. And as long as we're inside this range, keep referring back to them. Remember that the volume imbalance is the most flexible PD array I have, meaning that it's normal for it to go through it, back and forth through it. If it's going through the volume imbalance, which is the first expectation to have for it, because just because it's there doesn't mean it's going to stop price to the tick. It can, but you have to have context around it. So what I like to see is I want to see them trade through them. So it's going to lay a body down over top of it. So in this volume imbalance here, we've seen a body laid down and they buried a bullish body in that volume imbalance there on that candlestick. And then they laid and buried a body with sell side delivery. It means it's a down closed candle. So we have an up closed candle. This candlestick is up. So it's been offered what? Buy side. And then we see this candlestick here lay over top of that volume imbalance and it's sell side delivery. So when you see that, it becomes efficiently delivered. And then what I do is I treat that as a balanced price range. But because it's such a small, insignificant amount of price data, I don't hold everything on the basis of it creating this up candle over top of it and down candle over top of it. And now when we were already seeing the consequent encroachment, it already started to snap down lower. It doesn't mean it's going to keep dropping. It doesn't mean it can't go back above it and use it as support and rally. But I'm looking for those types of signatures when I'm watching price. A lot of times when I'm talking to you, my attention is looking at these volume imbalances or the PD arrays, and I'm waiting to see if the signatures that I'd like to see with them are manifesting. The value of the volume imbalance is you want to see how they trade through it. In this case, when it was created, it offered buy side. So what is it lacking? Sell side delivery. That's over here. So now because we have that, this volume imbalance is much more meaningful because it's offered both the buy side and the sell side delivery. So it's kind of like that paint roller analogy. If you got a paint roller and you press that roller against the wall, the first foot or so of paint delivery is going to be ample. There won't be any little pockets where the paint didn't distribute well to the wall until you get to a point where you start running out of that paint. And then you'll start seeing little pockets where it doesn't contain enough paint to distribute it to the wall surface. So what do you have to do? Roll right back over top of it. Well, that's exactly what price is doing inside the volume imbalance. It's delivering price up first, and then it delivers it down here. So now we went back above it here. So now this, it would be more helpful to me to see it not allow price to go back down below it. Doesn't mean it can't do it. Remember, this is the most flexible PD array, and you have to have that flexibility. You can't demand the same degree of precision that a fair value gap that's bullish, the consequent encroachment to it or the high of it, that level of precision that would be afforded to you there, it doesn't carry the same weight that you would expect with a volume imbalance. They still can travel through them and come back up and then resume. What would cause that to happen? The time aspect, the macro. So when I'm using my volume imbalances, I many times will side with my buy. Basically what I did in London. I knew I was looking to go long. I'll use the volume imbalances to start positioning. And then once the positioning is afforded to me, when the time aspect kicks in, then I'm really going to be looking for the price to start displacing and spooling in the direction of my target. I can then use the volume imbalance again as a new entry, or I can use it as a means of managing my stop loss. There's a little bit of management that's required when using the volume imbalance. We're inside the 850 macro now. The liquidity here is minor buy side. Now look at the difference between this volume imbalance where we had initial buy side delivery, sell side delivery. It just means that the market has been offered on the up and then on the downside. And then we use the consequent encroachment here, and then finally it drove through it. So now this is much more significant as a balanced price range on the basis of a discount array, not a premium array, meaning that if it would have came back down and touched it, we treat it like a support level basically, because it's done the efficient delivery between both, and then we left it. And at any time back to it, it would act as a discount array to send prices higher or support price, and then say you were long in here or long over here. Then you could roll your stop loss right below that volume imbalance because it's done its work in framing out a balanced price range because it's delivered buy side, sell side delivery, and then left it here. Collect a lot of instances where you see this event happening and you'll know exactly what I'm talking about. Just seeing one example isn't sufficient enough, I promise you. What's the difference between this volume imbalance and this volume imbalance? This volume imbalance has no body buried over top of it with either sell side delivery or buy side delivery. We just have a wick there. And then we have this, we're here. Just a wick. There's no bodies buried in this range at all, zero. So when it left here like that, this is behaving just like a breakaway gap. There's no bodies left there. It did traverse both sides of this area here with this pass down. It went down through it and came right back up all in the same candlestick. That is not the same thing as being delivered like it does here, one candle, and at a later time being delivered on the downstroke. So we have buy side delivery, sell side delivery. Here we just have one little return back into it, doesn't lay a body down over top of it at all. It just rips and runs away. We should see it rip through that minor buy side here. Let's take a look at where we are in relationship to yesterday's 414 settlement. Yeah, we have a pretty good gap. So we have a premium gap in the making. So we're way up here. Let's play devil's advocate for a moment, okay? Let's say we trade above here and we don't rip and just take off. With a gap premium opening, the likelihood of the market wanting to go to 50% of that gap would easily take us into the run below these lows here, into this, and maybe even so much as a run below here. And then retail would be very reluctant and want to be long because it's doing that type of thing at the opening bell. And then we could change gears and then start working towards a run on a higher time frame, avoiding the top picking dilemma and gravitate towards here. But it's all dependent on how it runs here because we've cleared the minor buy side. I don't want to see it take off from there. I want to kind of see it stay close to this range and just hug around it. It doesn't need to be in the lower half of it. It just needs to not run up there. And then what would happen is it would set the stage for a small little minor initial Judas swing higher, but not really do anything. Take out a short-term high that's left prior to 9:30's opening bell, and then drop, send us down into a discount, try to trade for half the gaps range between where we open at 9:30 versus 414 settlement price. Because that's something I would anticipate, I would be looking for something to clear up all these lows in here, trade down to this inefficiency, and maybe so much as going down below there. But that is, again, if we don't just start running higher from here. If we start ripping higher like this, if it gets to like 600 before the opening bell, I think they would just use the Judas swing at the opening bell, take us up there, sweep that, and then do some kind of a run on the opening range gap. So there's a lot of scenarios there, and it's all contingent on what the actual opening price is, because you don't know what that price is. I'm waiting for it just like you are. So at 9:30 opening bell, that opening price tells the story of what I just described. What scenario would I use? I just gave you several of them, but based on what it's doing and what it has done at the time of 9:30 would be the basis of how I would trade the opening range and how I would trade the opening range gap and what I would use for my setup and where my draw on liquidity would be.